Everybody, welcome to the morning market briefing. It's Thursday, June 23rd, 2022. Hope you're doing well out there. We do have initial jobless claims coming in. Last week's reading was at 229,000. The expectation is for 226,000. That'll be flowing in here any moment. As we get started, Dow futures up 40 basis points, S&P futures up 60, NASDAQ futures up 79 basis points. So seeing some green once again today. Oil down just a teensy bit, as Natalie in our office would say. So we're off a little bit. Ben, we getting anything on the jobless claims?
Well, to set the stage, I think the thing to look for is the 4-week moving average. That's continued to be ticking up. The last down tick was on April 1st. We hit a low of about 170,000. Now the 4-week average is up to 218,000. And we got a 211,000 number rolling off. And I'm trying to find what's going on the jobless claims right now. And yeah, it looks like we're at 229,000 jobless claims.
So flat.
So flat versus last week, but again, that 4-week moving average is going to tick up because you got a 211 rolling off. So that 4-week moving average is going to go up to probably about 222,000. So continuing to see a little bit more in terms of the initial jobless claims. We're not seeing the big numbers yet, but again, when it starts to happen, I think it'll happen relatively quickly.
We did hear from Jay Powell yesterday. We listened to it for a while. Actually pushed our weekly investment committee meeting back a few minutes because the testimony was just so electric. I mean, so much of this just seems like political posturing, trying to get sound bites in. I mean, Powell kind of toes the party line of what a Fed chairman is supposed to say. There is so much questioning outside of things that have anything to do with actual monetary policy. And he just kind of pushes things off and says, I'm not really here to talk about that. I'm here to talk about what our mandate is. But I did think, I echo you, Ben, in your notes. I thought he sounded a little more hawkish, a little more willing to do what has to be done, a little more mindful that, there could be a recession coming. What observation did you have at a high level?
Yeah, I think that he was really trying to stay tuned. I mean, he was playing the room, and right now the room is concerned about inflation. They're concerned about getting reelected. This is in front of the Senate, so not all of them are up for reelection. He does testify in front of the House today, so all of them will be up for reelection here in the fall. So expect more talk about inflation. And so he's pushing back on that, saying that price stability is the priority. There were some senators who were seeing the decline in the economy and are a little bit concerned about that. One of which is Elizabeth Warren. She said that she asked / commented, what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that before you drive this economy off a cliff. And to which
cooler heads.
To which he responded, the other risk is that we don't restore price stability and that we will allow this high inflation to get entrenched. So that is definitely a priority for him. You're seeing it reflected in the interest rate probabilities for the remainder of the year. We're now up to 14.5 implied rate hikes, which would put us close to 4% for the year. What's interesting about that is that now you're starting to see expectations for rate cuts by the time we get to this time next year. So the idea being raise the rates extremely aggressively, hit inflation, but that's probably going to cause a little bit of recession. And that's one of the reasons we're seeing some relief in the bond market. Yeah. Interest rates coming down just a little bit. We had a big decline in mortgage rates yesterday, about 20 basis points down to about 5.9%. So we're starting to see interest rates get a bid, see bonds get a bid, which is good for portfolios. It does result in a little bit more of relief on the value of some of those bond instruments. But again, Powell's going to talk in front of the House today. I expect him to continue to be a little bit more hawkish. And basically right now, the hawkish dovish tilt is he talking about inflation or is he talking about fending off recession? And yesterday he said, inflation is the priority, hopes we can avoid a recession. He did note that there's actually a chance of recession, which is more than he did last week.
Yep.
But he still doesn't see it as the most likely scenario.
Gas shortages in Europe really starting to kind of come to a head, especially with Germany, which gets 35% of its gas supply from Russia. German economy minister Robert Habeck has raised. I like that they have kind of threat levels on the gas situation. They've raised to the second highest alarm phase. If they go any higher, phase 3 emergency would actually involve them rationing gas distribution across the nation. How do things kind of shake out? And I mean, is there any end in sight to this stuff?
Yeah, so importantly, this is natural gas. So used in heating, it's obviously used for industrial processes like chemicals, pharmaceuticals, even metals and smelting like that. When Germany's a very industrialized economy, they do export quite a lot. And so the higher natural gas prices can really hurt them. Down the line, this could really have some implications for more supply chain disruption and more inflation. In the near term, what does this mean? It means that we're one level away, as Andrew pointed out, of kind of this rationing, what they call state control over distribution. They would prioritize consumers and critical public services like hospitals, but they would see significant supply cuts to things like restaurants and movie theaters and things like that. About over a third of Germany's gas comes from Russia. And what they're trying to do is they're trying to stockpile a lot of natural gas stockpiles by November so that they have some for the wintertime. But right now, those coffers are only 58% full, and their goal is to get to 90% full by the wintertime. So they're really in a difficult time right now. And importantly, with high natural gas prices, a lot of these power suppliers are actually having major losses because they're selling power for
A fixed
set prices,
Yeah.
and they're seeing their cost structure just accelerate to the upside, which means that these, and Habeck talks about these minuses, and it's minus after week after week after week. And he said that enough of these minuses pile up, and then you'll just have the bottom fall out, and you'll have an untenable situation, which he actually called out. And he said, if the minus gets so big that they can't carry it anymore, this whole market is in danger of collapsing at some point. So a Lehman effect in the energy system. So definitely sounding the alarm. He's going to be talking to other European countries, which also gets into the European Union. And we've talked about this for the last 3 months. You're trying to play on the same field, but Germany's going to want more gas than Italy, is going to want more gas than Greece. And people who are freezing want to be able to heat their homes, and they don't want to be subjugated to another country. And I think this is where some of those fractures in the European economy could be seen. They're trying to get the rest of Europe to cut energy consumption. They now have the option to enact legislation that will allow energy companies to pass on cost increases. So expect prices to go higher for German goods. And again, I don't think that is good for the supply chain or the prices here in the United States.
Yeah, it's going to have that ripple effect in so many ways. KB Home came out, pretty good quarter, nice guidance, a little bit of a different tone than Lennar. Order rates, they think, are moderating, but they're moderating from exceptional levels. I think thematically, Ben, the most important thing here is that they see this a little bit more as a pause rather than a new narrative that's starting altogether on the home front. How would you, I guess, kind of reconcile what they're saying with what Lennar said last week?
Yeah, so 2 items of distinction. Number one is they provide a little bit more color than Lennar did. They say, and this may be a guess on their point, but maybe it's an educated guess. And their standpoint is, look, we have FICO scores that actually showed a sequential improvement. You have people still putting down $75,000 on down payments. The average household income of these buyers is $125,000. And when they get in the showroom, they're actually buying everything. They're upgrading just as much as they were before. So they're basically saying, look, this is not a result of people not being able to afford the home. It's a result of sticker shock. They thought they had a certain budget, and now that budget has to be increased. And they're pausing. They say, with all the stuff in Ukraine, with this inflation thing, do I really want to buy this house? That's how KB Home characterizes it, versus
They just can't afford
They
it.
just can't afford it. Exactly. So I think that's an interesting nuance that KB Home put in. What Lennar did say that KB Home didn't say, Lennar said after the quarter ended, meaning in June, things really slowed down. And KB Home kept citing data that said, look, May is the last month for which we have full data, and it's solid data. So, you know, if you want to be bearish, you look at Lennar and discount KB Home. If you want to be bullish, you look at KB Home, discount Lennar. It's a bit of a Rorschach test at the moment. I think the truth is probably somewhere in the middle. Housing is slowing down. Question is why? And that's the big question that needs to be asked.
And I think that's an interesting point. I mean, I think something that we've probably not talked about enough on the show, probably not talked enough even in investment committees, is the actual human component and human decision making that to some extent may be a byproduct of all these things we're talking about: interest rates, supply chain, fears of recession, but also to some extent is just, I don't know if I want to do this right now because there's just uncertainty in a generalized form. And I think I was talking with Jonathan McKay, we call him Banjo. I was talking with Banjo, one of our CPAs, last night about something. And I use this illustration. It's like in December and January, I was kind of thinking about buying a new vehicle. I could still afford to buy that vehicle. I could afford to buy it even at elevated prices. But ultimately, I was just like, nah, I'm going to wait. I'm not looking. I'm not shopping. My car's fine. It'd be nice to have a nicer car, but I don't really have to do it right now, especially if it's going to cost me more than I feel like it should. And that's an instance of just, one person making a decision to not enter the pool of demand. And I think KB is probably accurate in that some people are hitting the pause button. Some of those that pause are not going to revisit. They're not going to go through with it. And that's the part that's probably a little bit harder to quantify, because all the indicators we get that are really lagging indicators. We get data on all kinds of different forms of consumption, but we get it after that period. But at any given moment, there's people all over the country right now saying, you know what, I was going to buy that watch, that car, that shirt, those shoes, whatever, that trip, and I'm just going to wait.
Yeah, I mean, I think it gets to the human nature aspect of it. I think that, we've even said on this show, I mean, I think it's a direct quote from me, just said, be smart about where you're investing, be smart about how you're spending money. Just don't be stupid, especially in this environment that we have right now. And right now, I mean, I think that even if I talk to people who just bought a house, they would probably tell me, yeah, it's probably not the smartest decision in the world to buy a house right now at this point in the market with the top and potentially recession coming, but we just really want to get a house.
Yeah.
I think that would probably be the conversation. And people don't like to be stupid or feel like they're making a stupid decision. So I'm not saying it is a stupid decision, right, but I'm saying that's how it feels for a lot of people right now.
Yeah. Yeah. And I think we mostly use this show to talk about headlines and what's going on, not give advice. But I mean, this is very much financial advice. Don't be stupid. Don't be stupid. Maybe we should start closing every show that way. Maybe we'll start today. Mark Zuckerberg, CEO of Meta, the company formerly known as Facebook, was on Jim Cramer's show last night. Ben, what was the theme, the tone of his remarks? I mean, the guy can kind of get a little bit scattered. What were your takeaways?
Yeah, he talked a lot about the metaverse. It's definitely a passion for him. But interestingly, he also talked a lot about the business. I think it is interesting that he went on Mad Money rather than a talk show or something to show what the metaverse is. I think that he is very much interested in getting the stock price up. He's talked about getting artificial intelligence and how they're using that aggressively for advertising, about how they're using it aggressively to get the best content in front of their Instagram people with reels and things like that, and how it's keeping more people on the platform. So he talked a lot about that. He talked about the loss of Sheryl Sandberg and how she's leaving the company and the new structure of the business. He did say they will modulate investments if there is a recession. And I think ultimately his agenda here was to, yes, talk about the metaverse, get people excited about the long term for what was Facebook, what's now Meta, but also, he's got a lot of people who work for him who have a lot of stock options, who were worth a lot of money, who aren't worth nearly as much money anymore.
Yeah.
And I think that he understands that. And I think even just his employees want to see him taking the stock and using it as a priority. Does this mean the stock's going to go up? I don't know. That's a big question to ask. It's tough to fight the headwind of falling advertising demand, but it does seem that Zuckerberg realizes that this is an imperative right now. In order to retain people, in order to improve the stock price, he needs to get out and be telling the story a little bit more aggressively.
Yeah, he's got to. And I think I don't blame him for that. I mean, Zuckerberg's kind of a tough guy to like in a lot of ways. But to an extent, maybe the last year notwithstanding, it's relatively hard to argue with his track record. He's done things that people have repeatedly say, why is he doing this? And it's worked out pretty well. The metaverse is so hard to really grapple with. And I think, you mentioned you kind of identified it as a passion project. I think my concern as an investor is like how much of it is a passion project and how much of it is reality. That's something that I think the market is very much grappling with. But we're also looking at Facebook. I mean, it's a flat out cheap company right now. So it's very much shifted out of that high growth category to one where now you're looking at, almost more of a sum of the parts. What could they be? Is this undervalued? Are these assets undervalued? People, the infrastructure, all of that. And that's not necessarily probably the market or analyst narrative that they wanted to tell. We like value stocks. When you fall from being a growth stock to a value stock, it usually is because your stock got punished severely. And so that's kind of what's played out. But it's been interesting, I think, even just internally kind of reframing the conversation around Meta.
Yeah, I agree.
We'll wrap it up there. We'll be back tomorrow morning. Hope you guys have a great day and don't be stupid.